Wow, the stock market is falling day after day right now, and many of you may be wondering, what is going on right now? Nasdaq is down over 2% for the day, and S&P and Dow are both down at least 1% at the time of this recording, and this is preceding multiple downfalls the previous days. In this video, I will cover why the market crash is worsening, and what you should do during this time of crisis. Welcome to Kazgains Academy. If you're new to the channel, please consider subscribing for more content like this, and let's get right into it. Many economists often use what's known as the Consumer Price Index in order to track inflation. The Consumer Price Index essentially tracks a basket of items that consumers in the US purchase, as well as energy and housing costs. This basket contains plenty of items, and its prices are tracked over time. Then, it is compared year over year and month over month with what prices were at previously. Investors use the CPI to measure inflation overall, especially on the consumer side of things. In the most recent April report, US consumer prices were up 4.2% from last year, or April 2020. That is a tremendously large amount, as investors were only expecting a 3.6% increase from a survey done by the Dow Jones. Not only that, but the Dow Jones was expecting a month-over-month price increase of 0.2%, but instead, we got a month-over-month gain of 0.8%. This price movement was spearheaded by energy prices, which increased 25% year over year overall. That's right, 25% year over year. Additionally, gasoline prices were up 49.6% year over year, and fuel was up 37.3% year over year. Furthermore, used car and truck prices went up 21% year over year, which represented a 10% month over month increase. And this doesn't even include assets like commodities. We've seen this literally unfold in front of us over the past couple of months, with lumber up 124% just in 2021 and copper up 36%. Copper sells for just over $4.50 a pound at the moment, but some natural resource investment firms can see copper running up to $15 a pound. That's right, if we take a look at copper prices over its history, we can see that it has never even gone close to that price. In fact, we are already at its previous peak of around $4.50, and have seen a huge price increase already in the past year. Yet, while these inflation numbers are definitely quite high, we need to gain some perspective as to what is happening. First of all, we need to bring these numbers back to reality. The base effect has exaggerated these numbers in a way that is perfect to scare investors. The base effect is essentially when we compare positive numbers with negative numbers year over year. Last year, we were in the middle of a widespread pandemic, which led deflation to occur in April of 2020. Therefore, when we compare the inflation in 2021 with the deflation in 2020, we are taking a positive number and subtracting it with a negative number. The Federal Reserve Chairman Jerome Powell estimates that this base effect exaggerates the numbers by 0.7 to 1%. So realistically, the inflation numbers are up 3.2% to 3.5%, which is still a huge amount. The numbers we saw represented the fastest CPI rate increase since September 2008. Economists are now panicking in response to this event. This is not supposed to be happening, and investors are starting to think that this inflation wasn't just transitory. Nevertheless, these numbers are not going to create action on their own, but they are definitely a sign of much more inflation coming. Ian Shepherdson, a well-known macroeconomist, explained how the Fed is not going to panic after one startling CPI report, so you can expect to hear even more about transitory bottleneck inflation pressures over the next few weeks. But this report does mean that the first part of the higher inflation story, the reopening spike, is real. It's no longer a forecast, and further hefty increases are coming. In other words, short-term high inflation is actually here. It's no longer some kind of conspiracy theory. It's real, and the Federal Reserve has to deal with that now. Now on the flip side, Oxford Economics takes a different stance. They think that this isn't the start of an upward inflationary spiral. Oxford Economics looks for supply and demand imbalances to gradually be resolved, and the pace of inflation to gradually cool heading into 2022. That statement makes sense in theory. Companies know that demand is about to spike due to the reopening of the economy. In reaction, they have now ordered huge amounts of inventory to catch up with supply in the future. This could mean that while demand is drastically exceeding supply right now, supply will eventually catch up. Either way, we know one thing for sure: inflation is here. But I don't think anybody should be surprised, given the Fed's action since the pandemic started. With that out of the way, let's get into how I'm personally reacting to this event, and what I think investors should do during this time. Of course, none of this is financial advice, and you should always do your own due diligence. With that being said, let's get right into it. The market's reaction has been very dramatic following the inflation panic. Stocks, and tech stocks in particular, are reacting in a drastic manner. Although inflation is indeed here, as informed investors, we need to realize what is actually happening. As we discussed the base effect earlier, seeing the 4.2% increase in the consumer price index is obviously causing adverse reactions and a lot of emotion. Yet, these numbers are exaggerated, and the crisis is not as horrible as it seems. In the long term, inflation is likely to level out, and the current fears are overblown, as supply will eventually catch up to demand. I see our current situation as an opportunity to take care of fear, uncertainty, and doubt. Investors certainly do not enjoy having these emotions, but over the long term, the US economy will come out strong. The US has gone through many economic crises in the past, and looking back, the stock market has only survived stronger than ever through these crises. Just in the 1990s alone, we had the special period in Cuba, the early 1990s recession, Finnish banking crisis, Swedish banking crisis, 1994 economic crisis in Mexico, 1997 Asian financial crisis, 1998 Russian financial crisis, the 1998 Ecuadorian financial crisis, the Argentinian economic crisis, the Samba effect, and lastly, the dot-com bubble itself. Right after that, we had to go through the 2001 Turkish economic crisis, 9/11, and the Uruguay banking crisis. Nevertheless, since then, the stock market has only gone up over the long term. Imagine being afraid of all these crises and staying on the sideline the whole time. The returns you'd be missing out on are absolutely insane. My point is that I'm buying the dip and continuing to hold almost all of the positions I already have. The investments I purchased I know are great businesses with great upside potential. Remember that while stock prices are fluctuating, the fundamentals of the business you own have not. Over the long run, it all depends on how you react in times like these. Personally, I'm not buying in with all my cash right away because if I did, I wouldn't be prepared for a potential further downfall. Instead, I am dollar cost averaging and being prepared for anything. Go ahead and take a look at the stocks you own after this video. Are those truly remarkable businesses that will continue to thrive over the long term? If you find yourself doubting, then either go do some research or sell that stock and purchase companies you have a higher conviction in. As Kathy would have said in the past, in times of crises, she concentrates her portfolio on her high conviction stocks. Let me know if you're buying the dip and what stocks you plan to or have already bought down below.
I missed that one, I'll catch the next one. That usually does not work. Toys R Us, there was a lot of copycats of Toys R Us. There was Child World, there was Lionel, there was copycats of Home Depot. Buying the next of something usually doesn't work. It's very bad. It's like buying on dips. I think it's always better to buy from dips. I always thought it was a better rule than buy on dips.
Thank you for watching, and if you enjoyed this video, please hit the like button and don't forget to subscribe, and I'll see you in the next one.